Hello, welcome to this episode of Rich Insights. I'm Don Rich, the Chief of Investments, or the CIO of Esoteric Capital Management. All right, today's topic is Tina says cash is trash. Tina says cash is trash. All right, that expression, cash is trash, was recently made by Ray Dalio of Bridgewater and Associates, right? The famed hedge fund. What we want to do today is try to better understand what it was that he meant by that. It is a very profound statement. What he really means is that this is one of the most difficult investment environments that we've experienced in recent history. Now that's quite a statement. This is one of the most difficult times to invest in the last few years. Right? And the reason for that is because there seems to be problems with all asset classes. All right, so let's walk through them one by one, and I think you'll see what I mean. Now, let's start with equities. Now, we've had many segments on this, and we've talked about the lofty valuations, right? That's probably the biggest problem with equities as we're sitting here today. Just how lofty they are, we can argue about that. But by any metric, equity valuations are lofty, right? We're in this period of the longest expansion in economic history, and stock prices have been driven up, and we end up with these very, very high valuations. All right, that's the first problem with equities. The second problem is we have what seems to be this unlimited supply of stock buybacks right now. All right, stock buybacks are when a company buys back its own stocks, buys back its own shares. Now, if a company has excess earnings, right, excess cash, excess profits, and they have nothing better to do with it, then buying back their own stock is a legitimate strategy, right? It's a good idea. But the problem comes when companies start issuing debt just to continue these buyback programs that they promised the market. Or companies are issuing debt now in some cases just to maintain their cash dividend. Right? That's when things start getting a bit concerning. Right? You don't like those. Well, in addition to that, we're also seeing what I call segments or episodes of a wolf in sheep's clothing. All right? We're having mattress companies that claim they're tech companies. We're having exercise companies that claim they're tech companies. Car companies that claim they're not car companies, they're tech companies, right? Everybody wants to get on this tech bandwagon because the tech rally is what has driven most of the equity price appreciation. That has been the leadership of this run-up. So everybody wants to tie their cart to that horse. And that becomes concerning. Right, on top of that, right, the fourth thing fourth reason I worry about equities is just quantitative easing. This whole nationalization of our financial markets. We talked about this in previous segments. All right. So there's a lot of reasons you could get concerned about equities now. And again, I'm of the boat. I think this longest period of expansion in economic history still has a ways to run. The horse is getting tired, but I think he still has further to run. But even with that, you have to recognize all of the problems, all the symptoms of this horse getting tired. So if our equity horse is getting tired, then what? Well, again, remember the title here is Tina Says Cash is Trash. Well, the Tina part is not the name of my girlfriend or my wife. Or Tina is an acronym, and it stands for There Is No Alternative. All right? And you'll see what I mean by that in a second here. So if we're concerned about equities for one of many possible reasons, what about fixed income? Fixed income is the second largest, or second most popular investment class. It's actually the largest investment class. What about fixed income? Well, right now, 10-year treasuries have a lower yield than 3-month cash, right? 3-month investments pay a higher yield than 10-month treasuries, right? These yields are expected returns. So I'm expected to earn a higher rate of return by just sitting on the sidelines, sitting in cash, than investing in 10-year treasuries. It doesn't happen very often, right? It's what economists refer to as an inverted yield curve. An inverted yield curve. And that's, again, it doesn't happen very often, but that is the environment that we live in today. So the only way that treasuries are going to be more attractive to cash is if we get some interest rate declines. And interest rates don't only have to decline, they have to decline more than the market's already pricing them in to decline. Right? So the market's expecting rates to fall. So for you to come out ahead on a treasury bond, a 10-year treasury bond position, interest rates have to fall more than the market's already pricing them to fall. Otherwise, cash is more attractive. All right, so let's chase that. What about cash? Is cash the alternative for equities? Well, sometimes, perhaps. Is now one of those times? Well, no. This gets back to the cash is trash point. Right now, cash has a lower return than inflation. Right? The 3-month interest rate is below the inflation rate. It's what economists call a negative real rate of return. What the hell does that mean, fat guy? There's a bunch of economics talk. What does that mean? Well, in simple terms, it means if you invest in cash, you're guaranteed to lose money, to lose spending power. To lose spending power going forward. If you invest in cash, you're guaranteed to lose spending power going forward. So, cash is not without its problems. So if we're concerned about equities, and treasuries are not attractive unless you think rates are going to fall substantially, and cash, you're guaranteed to lose money, that only leaves commodities. Right? And particularly some of the commodities, like gold and silver and so forth, have recently run up in price, had a run up in price. And the reason for that is people are looking for a store of value. They are looking anywhere, elsewhere, outside of equities. They're looking for an alternative for a store of value. So, we may be in one of these really unusual environments. If equities would have a serious pullback, we would actually be asking ourselves, where can I lose the least amount of money? Where can I lose the least amount of money? Again, that's why this is probably one of the most difficult investment environments of recent history. All right, so that's our message for today. It's February 19th. You've just experienced a rich insight. I hope you enjoyed it. We'll talk again soon. Thank you.